The markets can rise like the morning sun and fall like a storm without warning. Tonight, we take you deep inside the roller coaster of India's most unpredictable, most volatile, and most fluctuating stocks, the ones that can make fortunes in hours and wipe out gains in minutes. Every tick of the stock exchange tells a story of ambition, risk, victory, and heartbreak. Behind every green arrow and every red drop lies the pulse of millions of investors watching their screens, holding their breath. Some call it chaos, others call it opportunity. But what truly drives this storm of fluctuation? In India's financial heartbeats, from Dalal Street in Mumbai to trading apps buzzing in small towns, volatility has become the new rhythm. These are not just numbers on a screen. These are the forces shaping industries, driving headlines, and testing the courage of every investor. And as billions of rupees move with every swing, one question looms large: which stocks are spinning faster than the rest, and why are they so difficult to predict? From tech startups burning with ambition to energy giants facing global headwinds and banks balancing between risk and growth, volatility spares no sector. And in this unpredictable dance, fortunes are not just made, they're tested. For many, it's a high-stakes game. For others, it's survival. So, tonight, we're not just tracking numbers, we're uncovering the human drama behind them. The dreamers chasing sudden highs, the veterans weathering the dips, and the analysts warning of storms ahead. These are the stories that remind us, in the market's theater, fluctuation is not the exception, it's the headline. In the ever-changing landscape of India's stock market, one category has consistently captured the spotlight: the high-volatility leaders. These are the tech startups, the small-cap companies, the disruptors that burst into the market with bold promises and daring visions. They don't just trade stocks, they trade on dreams, on momentum, and on a sense of possibility that keeps investors glued to their screens. And yet, while their rise can be meteoric, their fall can be just as steep, often within the same trading day. Take the startup space, for example. Companies in fintech, e-commerce, or digital services are riding on the hope of tomorrow. They bring with them innovative ideas, futuristic business models, and a promise to rewrite the rules of the game. Investors, especially younger ones, flock to these names with the belief that they might be buying into the next giant, the next story of overnight success. But behind the glittering potential lies an undeniable truth. Many of these companies are still unprofitable, still untested in the harsh winds of competition. Their stock prices often swing wildly, driven not by steady earnings but by whispers of growth, by speculation, and sometimes by nothing more than market sentiment. And then there are the small cap players, companies with limited market capitalization but boundless volatility. Unlike the stable giants of the Nifty or Sensex, these stocks live in the shadows of unpredictability. A single corporate announcement, a government policy change, or even a rumor in the market can send their prices soaring to new heights or crashing to unexpected lows. For some traders, this volatility is a magnet, an irresistible chance to make quick profits. But for others, it's a reminder that in the world of small caps, risk always walks hand in hand with reward. What makes these high-volatility leaders so fascinating is not just their unpredictability, but their ability to capture the collective imagination of the market. When they rise, they dominate the headlines, ignite conversations in cafes, and trend across social media. When they fall, they leave behind stories of dashed hopes and sleepless nights. They are the adrenaline rush of Dalal Street, the drama that keeps the trading floor alive. In the end, these stocks symbolize the heartbeat of a market that refuses to stand still. They remind us that for every cautious investor seeking stability, there's another chasing the thrill of uncertainty. And in India's fast-growing economy, these high-volatility leaders have become the stage where risk, ambition, and destiny collide every single day. When we talk about fluctuating stocks in India, we can't look at them in isolation. The truth is, the Indian stock market doesn't exist in a bubble. It breathes with the global economy, reacts to world events, and trembles every time international markets shift. This is the global ripple effect, and it's one of the most powerful forces driving volatility on Dalal Street today. Think about oil, the lifeblood of economies worldwide. India, as one of the largest importers of crude, is especially vulnerable to price shocks. When oil prices surge due to geopolitical tensions in the Middle East or supply chain disruptions, the impact is immediate. Transportation, manufacturing, even agriculture, every corner of the economy feels the pressure. Investors know this and they react instantly. Stocks of airline companies may plunge, energy firms might soar, and inflation fears spread like wildfire, shaking up sectors across the board. One headline from an OPEC meeting, thousands of miles away, can trigger waves in Mumbai within seconds. But oil isn't the only global factor at play. Inflation and interest rates, especially those set by the U.S. Federal Reserve, have become a daily obsession for Indian investors. A single rate hike in Washington can send shockwaves through emerging markets, drawing capital away from India and back into U.S. bonds. The result, foreign institutional investors pulling out funds, the rupee weakening, and Indian equities suddenly caught in a storm. It's a chain reaction, and every investor watching the tickers knows just how quickly those decisions abroad can alter fortunes here at home. Add to that the uncertainties of global trade wars, supply chain breakdowns, and even natural disasters in distant corners of the world, and the pattern becomes clear. Volatility doesn't always start in India. Sometimes it arrives like an aftershock, carried across oceans, magnified by speculation, and felt most sharply in the prices of Indian stocks. Technology shares, banking giants, consumer goods companies, none are immune. The same global ripple that drags down exporters one day might lift them the next, depending on currency shifts or trade agreements. Investors may sit thousands of kilometers from Wall Street or London, but their portfolios move in sync with decisions made in boardrooms and parliaments far away. This interconnectedness makes volatility inevitable. The global ripple effect is not just an influence. It's a constant reminder that in today's financial world, no market truly stands alone. For Indian stocks, the rise and fall of prices often echo stories written beyond its borders, stories that keep every investor's eye not just on Dalal Street, but on the world stage. Volatility doesn't just live in the risky world of startups or the unpredictable swings of global headlines. Sometimes the most shocking moves come from the places investors least expect, the traditional sectors, the so-called pillars of stability. Banking, pharmaceuticals, energy, infrastructure, these were once seen as safe harbors, but today they've become some of the most unpredictable players in the Indian market. Take the banking sector. For decades, it was considered the bedrock of the Indian economy, a place where investors parked their money for steady growth. But recent years have shown a very different story. Non-performing assets, regulatory crackdowns, changing interest rates, and even the rise of fintech challengers have created waves of uncertainty. A quarterly earnings report can transform optimism into panic in a single day. A merger or a bad loan disclosure can erase billions in market value before lunch. Banks, once the definition of stability, now ride the same roller coaster as the most speculative stocks. Then there's pharmaceuticals, an industry once thought to be insulated by steady demand and consistent global exports. Yet, surprises in regulatory approvals, pricing pressures in the U.S., or sudden patent disputes have sent pharmaceutical stocks lurching up and down. In an age where one drug approval can ignite a rally and one rejection can spark a sell-off, pharma companies have turned into case studies of volatility. Energy, too, has been no stranger to turbulence. Power companies and oil majors face not only global commodity price swings, but also the shifting winds of climate policy. A government announcement favoring renewable energy can lift green power stocks overnight, while fossil fuel giants struggle with declining investor confidence. Add in fluctuating coal supplies, electricity tariffs, and environmental regulations, and the energy sector feels less like a safe investment and more like a high-stakes gamble. Even infrastructure and manufacturing, the backbone of India's growth story, have become unpredictable. A new government policy can trigger optimism, sending shares soaring. But delays in execution, funding challenges, or sudden global supply shortages can just as quickly dampen that enthusiasm. The unpredictability lies not in the lack of demand, but in the complexity of execution, where even small disruptions have massive consequences for stock prices. These sector surprises remind us of one simple truth. No industry is immune to volatility anymore. The line between safe and speculative has blurred. In today's India, the most traditional names can deliver the most unexpected swings, leaving investors to wonder if certainty itself has become the rarest commodity on Dalal Street.